Today we are talking about one of the most misunderstood, yet most powerful candlestick signals in trading, and that is the Doji candlestick. At first glance, a Doji looks simple, almost boring. Many traders scroll past it without giving it a second thought. But experienced traders know something important. When a Doji appears on the chart, the market is trying to tell you a story. And if you know how to listen, that story can save you from bad trades and sometimes even put you in front of big moves before they happen. A Doji forms when the opening price and the closing price are nearly the same. During that time period, price may move up, move down, create long wicks, shake traders out, and trigger emotions. But in the end, the market closes almost exactly where it started. That single fact alone tells you something very important. It tells you that neither buyers nor sellers were strong enough to take control. Think about that for a moment. Buyers tried to push the price up. Sellers tried to push it down. Both sides spent energy, but neither side won. That is why the Doji represents indecision. It is a pause. It is hesitation. It is the market taking a breath. Now here is where many beginners make a mistake. They think a Doji means the market will reverse. That is not always true. A Doji does not automatically mean bullish or bearish. A Doji simply means uncertainty. What happens next depends on where that Doji appears and what the market does after it. Context is everything with a Doji. If you ignore context, the Doji will confuse you. If you understand context, the Doji will guide you. Imagine the market has been in a strong uptrend. Green candles keep printing one after another. Everyone is bullish. Social media is full of buy signals. Retail traders feel confident. Then suddenly a Doji appears near the top. That is not random. That Doji is telling you sellers are no longer in full control. They are pushing, but price is no longer moving down easily. This is why professional traders respect the Doji. It reflects the psychology of the market. It shows you when emotions are changing. One of the most important rules you must remember is this. Never trade a Doji by itself. A Doji is not a signal to enter. It is a signal to pay attention. The real decision comes from confirmation. Confirmation means what happens next. If a Doji forms and the next candle is a strong bullish candle, that tells you buyers have stepped in with confidence. If a Doji forms and the next candle is a strong bearish candle, that tells you sellers have taken control. Without confirmation, a Doji is just information. With confirmation, a Doji becomes a powerful trading tool. Another critical factor is location. A Doji in the middle of a range means very little. The market is already indecisive there. But a Doji at support, resistance, trend lines, or key levels is a completely different story. When a Doji forms at resistance after a long uptrend, it often signals exhaustion. When a Doji forms at support after a long downtrend, it often signals stabilization. This is why support and resistance are so important when trading Doji candles. Time frame also matters. On very low time frames like 1 minute or 5 minutes, Doji candles appear all the time. Most of them are just noise. They are created by short-term fluctuations and algorithmic trading. But when a Doji forms on higher time frames like 1 hour, 4 hours, or daily charts, it carries much more weight. Higher time frames reflect decisions made by institutional traders, hedge funds, and large players. A Doji on a daily chart can represent a major battle between buyers and sellers. Volume is another piece of the puzzle. A Doji with high volume means intense fighting between buyers and sellers. A Doji with low volume means lack of interest. High-volume Doji candles at key levels are especially important. One thing that makes the Doji unique is that it often appears before big moves. The market rarely moves in one direction forever. Before it changes direction or even pauses, it often shows hesitation. That hesitation is what the Doji represents. Many traders lose money because they trade emotionally. They chase price. They enter late. They ignore warning signs. The Doji is one of those warning signs. It tells you to slow down. Sometimes the best trade after a Doji is no trade at all. Waiting is also a position. Professional traders understand this. They do not feel the need to be in the market all the time. Another mistake traders make is trying to predict the future. The Doji